Good afternoon. This is Your Money Matters, and I am Angela Giroux. I've got Ted Bauman and Clint Lee here with their insights. And I just wanted to let you know that we are offering a free report to new Bauman Letter subscribers. If you click the link up here, you'll get more details, as well as how to join, subscription benefits, all that sort of thing. And it's a good one because it details one of Ted's favorite investments, and we're going to actually talk about it today. We're going to revisit what we spoke about last week, hedging strategies, Plan B. Now, to be clear, and I want to say this right up front, we are not saying that the sky is falling, that the market is about to crash. We're not saying anything like that. What we are saying is that you should be prepared, and especially in light of some things that are going on in the background here. First, of course, is inflation. And I'm going to pull up a chart just to show you just how bad it's gotten, in case you didn't know. I mean, look at that. We are over 6%, which we haven't seen, well, in over 20 years for sure. I don't, Ted, do you know the last time we've seen inflation this high?
It would have been beginning of the 80s, probably.
I think it's the highest since 1990.
Yeah.
Okay, so I was still pretty young. That's my excuse. But that's not the only headwind that we're facing. Unfortunately, COVID's making a return in Europe. If you look at this chart, you'll see new reported infections by the day, and they are up to 300,000 per day again. And that's a high that they haven't seen in months. And unfortunately, it looks like we might be right behind them. Take a look at this chart. Now, it's not quite as grim here in the US, but we are trending up once again, and that is a trend I don't like to see, and I don't think the market likes to see that either. When we were talking before we started recording this, and we're saying the market is really wound up like a mousetrap right now. So even if there isn't a big crash, there could still be a serious correction, or in the very least, I would expect some volatility. So Clint, can you explain a little bit of the dynamics behind that?
Yeah, there's really, I think, three kind of key things that could spring the mousetrap. Especially when you're talking about, kind of that flash crash scenario, as opposed to, some kind of a sustained bear market. So the first one is just, we've seen a couple different times this year already when investors kind of revolt against where valuations are. And so that picture has not gotten any better here at this point. So here's a chart that just shows collectively how the market cap of stocks with a price to sales ratio over 20 times. And so this plots us going back all the way back to about the early 1990s, late 80s. And really, right now we're running about 4.5 trillion market cap with, once again, this valuation measure of price to sales over 20 times. The only time we ever came close to that was back in the tech bubble burst when we were at 3.6 trillion. So, that's something that hasn't gone away. It's gotten a little worse. If you want to frame up kind of that price to sales over 20, how significant that is, while the S&P 500, kind of in its own bubble territory right now is trading at just over 3.2 times price to sales. So just to frame that up now, I want to go into the S&P just a little bit more right here and just look at the dynamics of what has really been the big force behind the S&P's move and its valuation right now as well. So here, this shows the S&P 500 going back to 2007, the blue line on here. It's compared against the MSCI all country ex-US index. So think of it as the rest of the world excluding the US, and you can see the S&P up over 3 times over this time frame versus despite all the ups and downs, the MSCI ex-US up less than 25% over that whole period. Now, where it gets interesting is when you start to decompose what's driven the S&P right here. So the next chart on here shows the S&P 500. If you take out 6 stocks, you've got Facebook, Alphabet, Apple, Amazon, Netflix, and Microsoft. That's the blue line on here. The red line is the remaining 494 names in the S&P 500. So just absolutely incredible how much those 6 stocks have contributed to the market's performance. Now, there's a reason for that. And that's because those six stocks have had some incredible earnings growth. So next chart shows you the same six stocks compared to the rest of the S&P 500 and what trailing earnings have been. So that's supporting that move higher for those names. But the drawback here is that price for those stocks has moved higher even quicker than what earnings has. And so the result is this right here. You've got the PE ratio for that group has jumped, especially since kind of the 2017, 2018 period. And so, especially if you're a passive investor, if you're holding an index ETF, you're susceptible to this. These six names are really you're driving this right here, and it's something to be aware of. And once again, if investors decide, who knows what the trigger may be? Maybe it's the interest rates and the inflation you're talking about earlier. But when they don't like it, when they decide they don't like it, watch out below. Now, there's a couple other dynamics here as well that could spring the mousetrap. One, is you hear about it quite often, and that's how much margin debt is out there right now. So margin debt balance is basically the amount that investors are borrowing to buy securities has just been, keeps marching higher. So here's a chart that shows margin debt going back to 2016, but you just look at the right-hand side of this. We are over 900 billion. We're approaching $1 trillion in margin debt, and the rate of change of this has just been quickening. So here, this next chart shows the year-over-year change in margin balances. This goes all the way back to 2008, but you can see just in red, this most recent episode kind of coming out of the pandemic, just how quick that has jumped. And so, what's the significance of this is because, if there's at least a regulatory minimum that if you're borrowing money to buy stocks, you have to keep at least 25% of your account in equity. Your brokerage might require that number to be higher. But if the value of that portfolio falls and you fall below that 25% threshold, you have to top it off. Now, if you're on margin, that probably means you don't have cash just sitting around to top off that minimum that you need to have in there. So you're forced to, this is the margin call, you're forced to sell stocks, and selling stocks creates more downside pressure, which, another margin call. And so just imagine that example happening at this $1 trillion scale, and you can get some quick unwind. So this next chart shows margin debt balances going back to the late 90s and just some significant drawdown in periods that you've seen, in 2002 when the S&P was down 50%, the financial crisis, the 56% drawdown, a couple more recent episodes in 2016, 2018, we really didn't recover from in terms of margin debt, the drawdown in 2018, but since the pandemic has just been quickly moving higher now. There's one more thing that could spring the mousetrap that I want to talk about that doesn't get as much attention, but it's becoming a much larger force in the markets. And that is what has to happen, what happens behind the scenes with all the options trading that we're starting to see. So we've seen just a huge jump in options trading. This chart illustrates that point. This shows how much and premiums are being spent on puts and calls going back to 2018. And just looking at the right-hand side of the chart here, you see this, especially the call figure has spiked to about $12 billion. Now, a lot of that is retail activity. That's evidenced by this next chart that shows how much of that call buying is happening in lot sizes less than 50 contracts. So just kind of a way to track a retail versus a larger institutional investor. And so here's why this matters. If you're going out and you're just buying a call or put option, you're making a bet on the direction of that stock price, right? Now, the person who sold you that option, the dealer, they just want to make money on the transaction. They just want to make money off the bid-ask spread of that option. They don't want to make that bet on which direction the stock's going to go. So, in the case of a call, to hedge their position, to get rid of that directional bias, one of the things they can do is they can go out and buy stock. Now, the relationship's not constant, depending on how many calls are being traded, depending on how the underlying stock price is moving, the amount of hedging they need to do or don't need to do, it's changing. The rate of change changes. So it gets very complicated. But the bottom line is that the impact of this hedging activity is starting to cause a lot of volatility in the markets. It can create a lot of volatility in single stock names, and because of how much certain stocks make up the indexes now. You can see it on an index-wide basis as well. So, so long as options are remaining popular, you can see a lot of volatility coming about because of that.
And Ted, I did promise these people that we would give them some ideas, and that it was one of your favorite investments. So I'm going to let you take over from here.
Sure. I just think, just to summarize what Clint is saying, is that there are a lot of structural features in the market that at a time of very high valuation, it doesn't mean that the market is going to crash and stay crashed, but it means that you could see some pretty steep dives in valuation, and they could last for a couple of quarters or so, and so you want to be hedged. So here's what I like. This is basically something. It's a nice article from a guy named Jussi Askola, who's a writer at Seeking Alpha. He came up with a nice little way of explaining why real estate investment trusts, which is one of my favorite investments, are actually a good thing to hold in this context. The first point Jussi makes is that REITs perform better in the aftermath of a derating. Derating is when that chart that Clint showed you earlier, where PE ratios climb, when the market says, no, we don't like them that high. We know the companies are growing and earning, but we don't want 20 times forward earnings. We only want 10 times forward earnings. So when that happens, prices fall, and here's what it did after the dot-com crash. QQQ, that is the Invesco, that's the Nasdaq, basically fell by 58% over that period. But look what happened to real estate investments, including REITs. They were up by over 200%. So what tends to happen when you have one of these big deratings is that people flee into solid real world assets and the revenue, the cash flow that they generate. And so that's what happened back then. We could see something like that again. The second thing is that when interest rates are rising, REITs tend to do better. Here's a chart that shows the cumulative returns before and after basically the Fed raises rates, and you can see this is prior to the rate and after the Fed raises. Before the Fed raises, stocks generally do well. As soon as the rates go up, immediately REITs start to rise, and they almost double the stock market over a 12-month period after an interest rate rise. So if we do see interest rate rises, REITs are a good place to be. The third issue is that a lot of these companies, like Amazon in particular, have been able to do as well as they have because they don't really have all that much competition in their space. But as I talked about it last week in my Friday video, Uber is a classic example of a company that is trying to build a moat and failing, and therefore cannot survive as a going concern, I believe, unless it radically changes its business model. That could happen. That could happen even to Amazon. I mean, just this morning, I read an article about how lots of companies are gearing up to become, online marketplaces to compete with Amazon, and that could also limit their growth, spook investors, derating. That's not going to happen to REITs, right? I mean, REITs are basically they own solid assets. They have, in a sense, each one is their own little moat, and that's a really great place to be in that kind of environment. The fourth thing is that we just can't expect to see the rate of growth that we've seen for some of these companies. I mean, basically, how much bigger can a company like Apple get? I mean, once everybody in the world has an iPhone, and a lot of people have MacBooks and all that, there's not that much further they can go. So the big question is, at some point, the market's going to say, we don't like this level of valuation because we can't see the future of this. Whereas REITs can just keep growing by acquisition. They keep adding new parts of to their portfolio. Each one generates more revenue, which means that their EPS grows, their share price grows, their dividends grow. All that kind of stuff is what makes that outperformance after a derating. The fifth thing is that when the pandemic is over, you're going to see some stocks that are going to crash, and they already have. Peloton has crashed, and it's directly a result of the end of the pandemic. So some of the companies, particularly the 20 plus price to sales, they're already crashing. So again, that's not going to happen to REITs. And the last point I think is the critical one, that when people are willing to pay 20 times sales for a company, they are betting, right? In theory, that company is going to catch up to that valuation. But in real life, here's what happens over the long terms. Here's a chart that shows 1998 to 2018, the average annualized return by asset class. And the very top one, REITs, right? Now, the S&P 500 is not too bad. It's 5.6. But at the end of the day, that came with a huge amount of volatility. Now, there's some volatility with REITs too. People tend to panic when something happens like the pandemic, but that creates an opportunity to scoop them up. So my call is have a look at VNQ, look at individual REITs. I dare say, read the report that Angela was talking about and see why we're so bullish on REITs. And I think now's a good time to create a core of your portfolio around something like that in case there's a whipsaw. Let the other ones go down, keep the REITs, let the money flow in, and wait for the other ones to come back.
Well said, and great reminder. So make sure you click the link, get the report, join the Bauman Letter, and make sure you tune in next week. Thank you.
Great Thanksgiving, guys.